Have you ever wondered if the choices you make every day are truly yours, or if they were quietly engineered long before you even thought about them? Imagine waking up tomorrow and realizing that every financial decision you believed was natural, logical, or instinctive was actually the result of a mechanism activated decades ago. A hidden financial gear designed to shape your behavior without you ever noticing. That gear is turning right now, influencing the prices you accept, the debts you carry, the risks you tolerate, and even the future you think you're choosing freely. And the unsettling truth is that most people never realize they are moving inside a system calibrated not to empower them, but to extract value from them. This is not about simple interest rates or inflation charts. This is about a pattern that appears again and again throughout history whenever elites seek to control populations without using force. Instead of chains, they use incentives. Instead of weapons, they use credit. Instead of commands, they use scarcity, fear, and the illusion of choice. The same blueprint that once silently directed entire empires is now embedded inside the global economy, wrapped in complexity, disguised as progress, and sold as convenience. But behind the curtain, the mechanism is the same. It is built to predict your reactions before you make them, to manipulate your decisions while you feel independent, to guide society toward outcomes that benefit a very specific few. So the question is not whether the financial gear exists. The question is how deeply it is already shaping your daily reality. When you realize how it operates, how it subtly pushes you toward certain behaviors and away from others, you begin to see the global economic system in an entirely different way. You begin to understand why crises seem predictable in hindsight, why inflation always hits the same people the hardest, why your freedom feels narrower every year, even though technology claims to expand it. And what you're about to uncover may shift the way you look at money, power, and your own choices. Before we continue, tell me something. Have you ever felt that the system was designed to keep you running but never arriving? If this opening resonated with you, share your thoughts in the comments. Let me know what part of your life feels most affected by forces beyond your control. And while you're here, make sure to hit the like button and check if you're already subscribed, because understanding this content is essential if you want to stay ahead of what is unfolding. What comes next might challenge everything you thought you knew, and the connection between these ideas will only get clearer as we go deeper. The moment you begin to question whether your financial decisions are truly your own, you have already stepped into a deeper layer of the system, a layer most people never see. Because this mechanism, this hidden financial gear that quietly directs your actions, didn't appear by accident. It was constructed deliberately, brick by brick, during moments of global crisis when governments and powerful institutions needed a way to maintain order without revealing how much influence they wielded. They understood that the most effective form of control is the one that feels voluntary, the kind that makes people believe they are choosing while their options have already been predetermined. And so, the foundations of this financial gear were set long before you were born, long before the modern economy looked the way it does now. In earlier centuries, rulers controlled populations through visible force. Armies, borders, and laws dictated the boundaries of people's lives. But as societies grew more complex, physical coercion became less effective and far more costly. Power needed a new instrument, something subtle, universal, and self-sustaining. That instrument was credit. At first, credit seemed harmless, even liberating, offering individuals and nations the ability to grow faster than their resources would normally allow. But once financial elites understood its psychological impact, once they realized how predictable humans become when they owe something, the concept evolved into a mechanism far more influential than anyone expected. This financial gear was activated every time a state increased dependency on borrowing, every time a population adopted a currency system designed to lose value slowly over time. Every time. Institutions pushed citizens into cycles of debt under the promise of opportunity. Eventually, what started as a simple economic tool transformed into an invisible framework shaping expectations, behaviors, and priorities. People began organizing their lives around repayment schedules. Governments structured their policies around metrics that measured compliance rather than prosperity. And corporations learned that the most profitable consumer was the one who believed debt was normal, inevitable, even necessary. As decades passed, the mechanism became self-reinforcing. It adjusted automatically to human behavior, predicting how populations would react to scarcity, to price changes, to fear, to hope. It became so deeply woven into the global economy that most people can no longer distinguish their authentic needs from the ones the system subtly implants into their decisions. And once you recognize that the environment around you has been engineered with this purpose, you begin to notice how early in life this conditioning starts, and how few people ever escape it. The financial gear didn't just emerge, it was designed through repeated historical experiments, each one fine-tuning the way societies respond to invisible influence. And from here, The story only becomes clearer as we follow the evolution of this machinery, piece by piece, until it reveals how it operates inside your daily life without you ever seeing its shape. Once the financial gear was set in motion, it didn't take long for governments and banks to recognize its full potential. They understood that if human behavior could be influenced by subtle financial pressure, then an entire society could be guided without ever realizing it was being steered. The key was to create a system where every decision people made, where to live, what to study, how to save, when to spend, would feed into a structure designed to benefit those at the top. And the most efficient way to do that was to make debt the lifeblood of the economy. It began with a quiet shift. Instead of backing money with something tangible like gold or commodities, governments moved toward currencies backed by nothing but trust and obligation. This wasn't a small adjustment. It was a fundamental rewrite of how value worked. When money is no longer tied to physical limits, the entire system depends on continuous borrowing, and that means the population must always feel compelled to take on more debt. Mortgages, student loans, credit cards, car payments, each became normalized until they felt like unavoidable milestones of adult life, not engineered incentives built to lock people into predictable patterns. Banks refined the mechanism further by monetizing every stage of the debt cycle. They discovered that they didn't need people to repay their loans quickly. In fact, the opposite was far more profitable. Long-term debt created long-term revenue, late payments generated fees, refinancing created new interest streams, and default, ironically, often produced profits through asset seizures and government-backed guarantees. In this structure, your financial struggles don't weaken the system. They strengthen it, feeding it with more leverage and more opportunities to extract value. Governments played their part by structuring policies around borrowing rather than production. Instead of encouraging citizens to build wealth through independence, they built models in which economic stability depended on perpetual consumption. If people stopped spending, the system would fall apart. So every incentive, every tax structure, every national strategy was shaped to ensure that the flow of borrowed money never slows down. Even crises became opportunities, moments when the public could be pushed deeper into dependence under the guise of relief or stimulus. Over time, the machinery grew more sophisticated. Interest rates, inflation targets, monetary policies, they all became gears within the larger mechanism, calibrated to keep individuals within a narrow financial corridor. Too much freedom, too much personal stability would break the design. But just enough pressure, just enough uncertainty keeps the average person compliant, predictable, and profitable. And the more the system learned from your behavior, your fears, your desires, your habits, the better it became at shaping the path you follow without you ever realizing that the path was constructed long before you stepped onto it. This is how a modern economy transforms human behavior into a product, converting your daily choices into streams of value that move upward through a structure built to ensure the gear never stops turning, no matter how much pressure it places on the people caught inside it. The deeper you look into the structure surrounding you, the more you begin to notice subtle indicators that the financial gear is not just influencing society at large, but actively shaping your individual behaviors. These signs often appear so ordinary, so unremarkable, that most people dismiss them as normal parts of modern life. Yet, when you examine them closely, they reveal a pattern of quiet manipulation that reaches into the smallest decisions you make. You start to see how effortlessly the system guides you toward choices that reinforce your dependence on it, choices you believe you are making freely while the real options have already been narrowed. One of the clearest signs is the way your sense of time is tied to financial cycles. You don't simply live by hours or days, you live by due dates, billing periods, grace windows, and renewal terms. Your calendar becomes synchronized with obligations created by institutions that profit from every delay or extension. Even the anticipation of these moments affects your behavior. You adjust your spending not based on your needs, but on the pressure of upcoming payments. This is not coincidence. It is conditioning. The system trains you to prioritize its timelines over your own. Another sign is how quickly your concept of value shifts in response to economic signals you do not control. When prices rise, you blame yourself for not saving more. When credit tightens, you feel anxious, even if nothing in your personal life has changed. Your reactions are predictable, almost automated, because the financial gear is designed to translate external pressures into internal emotions. These emotional responses, fear, urgency, guilt, are not flaws in your character. They are engineered outcomes, serving a mechanism that functions best when people internalize its demands without questioning their origin. You also see the influence in the way choices are framed. You are offered versions of the same decision disguised as variety. 30-year mortgage or 15-year, high-interest loan or lower-rate loan with hidden fees, rewards, credit card or low-fee credit card with fewer benefits. The illusion of freedom masks the truth. Every path leads deeper into the same structure. Even when you try to escape the system, The alternatives available to you are often built by the same institutions you're trying to avoid. And perhaps the most revealing sign is the normalization of financial stress. Somewhere along the way, society accepted constant worry as a standard part of adulthood. People talk about debt the way previous generations talked about weather, something inevitable, unchangeable, simply part of life. But this acceptance didn't emerge naturally. It was cultivated. And when people believe stress is normal, they stop questioning its source. They stop noticing how their lives are shaped by forces that benefit from that stress remaining constant. Once you begin to recognize these signs for what they truly are, evidence that the mechanism operates silently within your daily routines, you can no longer unsee them. They reveal how deeply the financial gear has embedded itself into your habits, your expectations, even your identity. And understanding these early signals is the first step to seeing the larger pattern that explains why the system keeps tightening around society, preparing the ground for events most people won't anticipate until they are already unfolding. If any part of this made you notice something about your own life that you hadn't questioned before, share it in the comments. Your insight might help someone else see the same pattern hiding in their everyday routines. The most revealing feature of this financial gear is not how it shapes personal behavior, but how it grows stronger precisely when everything else appears to be falling apart. Moments of economic crisis, which should logically expose the fragility of the system, instead become fuel for its expansion. Each downturn becomes an opportunity to tighten its grip, not through force, but through carefully engineered dependence. And while the public believes these crises are unexpected accidents or unfortunate cycles, the mechanism interprets them as strategic openings to deepen its influence. During crises, fear becomes the dominant currency. People seek stability, reassurance, and clear paths forward. The system knows this, and it responds by offering solutions that appear protective while binding individuals more tightly to the very structure that contributed to the instability in the first place. When markets fall, borrowing becomes the lifeline. When prices surge, credit becomes the cushion. When uncertainty rises, people cling to institutions that claim authority, even if those institutions quietly benefit from the turmoil. This dynamic ensures that the financial gear not only survives crises, but uses them to expand its reach. Governments and banks position themselves as saviors, providing injections of liquidity, emergency programs, and temporary relief measures. But these interventions often come with long-term consequences that the public rarely sees. Every bailout strengthens the institutions closest to the mechanism's core. Every stimulus package increases national dependence on debt. Every rescue operation ensures that the system grows more centralized, more insulated, and more capable of directing economic behavior in the future. Crisis becomes a catalyst, accelerating trends that would have unfolded more slowly under normal conditions. Even industries that appear to collapse during economic downturns leave behind opportunities for consolidation. Smaller businesses fall while larger institutions absorb assets at discounted prices. Wealth funnels upward and ownership becomes more concentrated. This pattern repeats across decades, across countries, across economic ideologies. Whether the crisis originates from speculation, political instability, war, or global disruption, the mechanism adapts instantly, framing its expansion as necessity. And because people are focused on survival, they rarely see how much control they are surrendering. In these moments, the system becomes more efficient at shaping expectations. It teaches individuals that security is something borrowed, not built, that solutions come from centralized authority, not personal resilience, that the path forward always involves returning to the same structures that engineered the constraints. It is a self-reinforcing loop, one in which crisis pushes people deeper into the mechanism, and the mechanism ensures that those crises leave permanent marks on the shape of global power. What emerges from each wave of instability is not a weakened financial order, but a more concentrated one, calibrated to respond faster, influence deeper, and guide populations with even greater subtlety. And as this gear tightens its hold, the next stage becomes inevitable, revealing the true cost of living within a system that grows strongest when everything else begins to break. As the system expands through crisis, its influence becomes so embedded in everyday life that people stop noticing where their choices originate. Instead of questioning why they behave in certain ways, they assume that their habits are natural expressions of personal preference. But beneath these routines lies a subtle architecture of economic pressure that shapes decisions long before they appear in your mind. The financial gear doesn't need to force anyone to act a certain way. It simply adjusts the environment so that one choice feels easier, safer, or more convenient than the alternatives. And over time, these patterns solidify into behaviors that seem entirely self-directed, even though they were engineered to serve the mechanism. You can see this most clearly in the way consumption becomes tied to identity. People don't just buy products, they adopt lifestyles constructed for them. Industries have learned that if they can influence how individuals see themselves, They can influence everything those individuals spend their money on. This is why economic structures no longer focus merely on selling goods, but on shaping expectations, desires, and even emotional needs. What begins as a financial system evolves into a cultural ecosystem, one where your perceived self-worth becomes intertwined with financial participation. Another layer of influence appears in the illusion of convenience. When every solution offered to you involves recurring payments, subscriptions, automated renewals, or credit-based access, your habits shift without your permission. Instead of ownership, you are guided toward dependence. Instead of saving, you are pushed toward financing. These models are presented as modern improvements, but each one strengthens the mechanism by ensuring that a portion of your income cycles back through the system every month without interruption. The gear turns more smoothly when people stop noticing how much they are feeding it. Even your stress responses become predictable inputs. When financial pressure rises, people compensate with emotional spending, impulsive decisions, or attempts to regain control through short-term gratification. Companies study these reactions, analyzing patterns at a scale no human mind could process. Algorithms refine this data, anticipating your vulnerabilities, and presenting choices that feel personal but are actually the result of statistical prediction. You're not simply reacting to the world around you. You are reacting to a world designed to provoke specific behaviors at specific moments. This influence reaches beyond spending and into how people plan their futures. Young adults delay starting families because the system frames security as something perpetually out of reach. Workers tie their identities to careers shaped by market forces rather than personal aspirations. Even long-term goals become filtered through the logic of debt, creditworthiness, and financial risk. The system subtly teaches individuals to measure their lives through metrics that serve institutional interests, not personal fulfillment. What makes all of this so effective is its invisibility. The mechanism doesn't announce its presence. It hides behind conveniences, traditions, and social norms. It rewards compliance with comfort and punishes deviation with financial uncertainty. And because these outcomes feel like natural consequences, most people never realize they are responding exactly as the system anticipated. They follow paths that were paved long before they arrived, unaware that their habits are quietly reinforcing the very structure that guides them. As these patterns become clearer, the next phase of the mechanism begins to take shape, revealing an even deeper level of influence, one that prepares entire societies for events they will only understand when it is too late to change course. As the financial gear shapes daily habits and quietly dictates the rhythms of life, it also performs another function, one far more strategic and far less visible. It prepares entire societies for the next crisis long before the crisis itself appears. This preparation is subtle, almost invisible, because it doesn't rely on dramatic warnings or explicit signals. Instead, it works through gradual normalization, slowly adjusting expectations so that when instability arrives, people respond exactly as the system needs them to. The mechanism doesn't simply react to crises, it anticipates them, molds behavior around them, and ensures that every shock strengthens its long-term control. One of the most effective ways it accomplishes this is through controlled uncertainty. When people live in a constant state of mild financial instability, they become easier to influence. Small fluctuations in prices, unpredictable fees, shifting interest rates, and changing job markets create an environment where individuals feel perpetually unprepared. This uncertainty makes them more dependent on the institutions that promise stability, even if those institutions quietly contribute to the instability in the first place. Over time, people begin to believe that volatility is normal, that unpredictability is simply the way the modern world works. This mindset ensures that when a major crisis finally emerges, they accept it rather than question the system behind it. Another tactic is the gradual erosion of personal resilience. As society becomes more dependent on centralized systems for banking, credit, housing, healthcare, and communication, individuals lose the skills and autonomy that once acted as buffers during economic downturns. When people no longer possess alternatives, when every aspect of life is tied to systems that can be disrupted with a single policy shift or market event, they become more vulnerable and more compliant. The mechanism thrives in environments where independence is scarce because dependence creates predictability, and predictability allows the gear to turn without resistance. Data plays an equally significant role. Every financial transaction, every digital interaction, every behavioral pattern recorded by algorithms helps refine the system's understanding of how people will react under pressure. This data becomes a predictive map of human behavior during crisis conditions. Institutions can identify which groups will panic, which will comply, which will resist, and which will adapt. This intelligence allows the mechanism to pre-position narratives, policies, and incentives long before the public realizes what is happening. By the time the crisis arrives, the response has already been shaped, not by public interest, but by the needs of the system itself. And then there is the most subtle form of preparation, emotional conditioning. Through media, education, and cultural norms, society is slowly taught that major disruptions are inevitable, that markets crash every few years, that recessions are unavoidable cycles, that inflation is something to endure. This worldview ensures that people blame the crisis, not the mechanism that engineered the environment leading to it. The system becomes invisible, while individuals internalize the consequences as personal shortcomings or unavoidable realities. Once you begin to see how deliberately this groundwork is laid, it becomes impossible to ignore the pattern. The crises that seem sudden, the shocks that appear unpredictable, the disruptions labeled as unprecedented, all of them fit into a larger structure that has been preparing society for their arrival. And the more clearly you recognize these preparations, the more you start to question what the next crisis will look like and how deeply its effects have already been set in motion. If something in this resonated with you or made you notice a pattern you had overlooked, share your thought in the comments. Your perspective might reveal a connection others have never considered. When you trace the evolution of this mechanism across centuries, a striking pattern begins to emerge. What appears today as a complex modern financial structure is not a recent invention, but the latest version of a blueprint refined through countless cycles of rise, collapse, and consolidation. In every era, a small group understood that controlling the flow of money meant controlling the direction of society itself. And each time a crisis reshaped the world, these groups adapted the mechanism, strengthening its reach and ensuring that no matter how the surface changed, the underlying structure remained intact. Every major empire, from the early mercantile powers to the industrial giants, relied on a financial engine designed to centralize influence. These systems may have looked different on the outside, but their internal logic was identical. They benefited those who positioned themselves closest to the creation, distribution, and regulation of money. Over generations, this proximity allowed certain institutions to become not just participants in the economy, but architects of it. Their decisions shaped national priorities, global trade routes, and even the values societies embraced. And through this influence, they discovered something more powerful than controlling resources, controlling expectations. You see this pattern during golden ages of prosperity. When societies expand and optimism rises, the mechanism tightens quietly, embedding itself deeper into the culture as people become increasingly invested in maintaining the system that they believe is bringing them success. During downturns, the same mechanism steps forward as a savior, positioning itself as the stabilizing force that can restore order. Both outcomes serve the same objective: preserving the institutions that sit at the center of the gear while keeping the population dependent on the solutions those institutions provide. Even technological revolutions, which seem disruptive on the surface, often end up strengthening the mechanism. Innovations in communication, computing, and data collection have given it unparalleled insight into human behavior. Every transaction, preference, and pattern becomes a data point that refines the system's predictive capabilities. These insights allow the mechanism to adjust in real time, shifting policies, incentives, and narratives to maintain control over the direction of global economic flow. Technology didn't weaken the structure. It made it smarter, faster, and almost impossible to detect. Across history, the same cycle repeats: concentration of power, manufactured stability, strategic crisis, and renewed consolidation. What changes is not the mechanism, but the story told to justify it. Sometimes it is framed as national security, other times as progress or modernization. But beneath each narrative lies the same pursuit of influence by those who understand that the most effective form of control is the one exercised through perception, not force. As you begin to recognize this pattern, one that spans continents, centuries, and economic systems, you start to see the modern world less as a collection of independent events and more as a continuation of a design that has been quietly steering humanity for far longer than most people realize. And the deeper you look into this structure, the clearer it becomes that the mechanism isn't just reacting to the present. It is shaping the future long before anyone sees its outline. The deeper you follow the threads of this mechanism, the more you realize that its current form is not its final stage. What we see today, the data-driven predictions, the engineered financial dependence, the quiet consolidation of influence, is only the visible layer of a transformation still unfolding beneath the surface. The system is evolving towards something more integrated, more comprehensive, and far more capable of shaping human behavior than any model that came before it. The next steps are already in motion, but their full implications remain deliberately obscured until the environment is ready to absorb them. One of the clearest indications of where the mechanism is heading lies in the convergence of financial infrastructure and digital identity. The systems that once operated independently, banking, consumption, communication, governance, are slowly merging into unified networks. This integration is framed as progress, as efficiency, as modernization, but beneath the presentation is a deeper intention: to create an ecosystem where every action, from a purchase to a movement to a preference, is recorded, analyzed, and ultimately used to shape what you will do next. The financial gear is no longer satisfied with influencing decisions externally. It is positioning itself to rewrite the frameworks within which decisions are even made. This goes beyond monitoring habits. It moves into the realm of predictability so precise that behavior becomes statistically manageable. Once the system can anticipate how individuals and groups will react under specific pressures, it no longer needs to limit their choices. It can simply shape the environment around them, guiding outcomes through invisible constraints. This is influence without confrontation, control without resistance. It is a silent architecture where the boundaries of what people perceive as possible shrink over time, restricting their imagination rather than their freedoms. Another sign of what lies ahead is the increasing reliance on programmable forms of value. As currencies become more digital, more traceable, and more adjustable, the mechanism gains tools it never had before. It can incentivize certain behaviors instantly, discourage others subtly, and create economic patterns that feel organic while being entirely manufactured. This technology is presented as an upgrade, a convenience, a way to modernize financial systems. But underneath, it is a recalibration of power that allows the system to enforce rules without the appearance of enforcement. Compliance becomes automatic, built into the flow of value itself. Even global coordination, once limited by national interests, is shifting toward alignment. International institutions, corporations, and financial networks increasingly operate as interconnected arms of the same mechanism. Their decisions ripple across borders in real time, reinforcing each other and shaping global outcomes with unprecedented speed. This coherence is not accidental. It is the result of decades of structural design that ensures the system can evolve smoothly into its next phase without meeting significant resistance from the populations it governs. All of this points toward a future where the mechanism becomes less visible, not more. Its power will lie in its subtlety, in its ability to blend into the fabric of daily life so completely that most people will never notice how profoundly their choices are being shaped. The next stage is not about controlling what you think. It is about shaping the conditions that determine what you will think about in the first place. And once this transition is fully in place, the final layer of the system begins to reveal itself, carried forward by a momentum that has been building across generations, preparing the ground for the moment when its ultimate structure becomes impossible to ignore. As the mechanism advances toward its most integrated form, its presence becomes almost imperceptible. It no longer needs visible structures or recognizable patterns to operate. Instead, it weaves itself into the assumptions people carry, the routines they follow, the expectations they adopt without questioning. This final layer is not built on force or persuasion. It is built on familiarity. When a system becomes familiar enough, it stops feeling external. It begins to feel natural, even inevitable, and that is where its power reaches its quiet peak. In this stage, the financial gear doesn't just shape behaviors or condition societies for future crises. It begins to influence how individuals interpret the world itself. People start measuring their opportunities not by what they could imagine, but by what the system has taught them to consider realistic. Dreams shrink to fit inside economic frameworks. Ambitions adjust to align with predetermined pathways. Even the idea of security becomes defined by structures designed to benefit from the very dependence they cultivate. The boundaries of possibility narrow without anyone noticing the walls moving inward. Yet within this subtle confinement, something else begins to emerge, something the mechanism cannot fully predict. When patterns repeat too perfectly, when systems become too synchronized, when influence grows too precise, people start sensing that something beneath the surface is shaping more than they realized. They may not understand its origin, but they feel the weight of its presence. And in that quiet discomfort, the first cracks in the illusion begin to appear. Not enough to break it, but enough to reveal that the story surrounding them is incomplete. This awareness doesn't arrive dramatically. It settles gradually through moments when individuals notice that their decisions feel strangely prearranged, or when entire societies move in unison as if responding to a script no one remembers agreeing to. These fragments of realization don't dismantle the system, but they do something more interesting. They create curiosity. And curiosity, once awakened, pushes people to search for connections the mechanism never intended them to see. What happens next depends on how deeply people are willing to look beneath the familiar. The structure ahead is not a single event, not a sudden disruption, but a series of subtle shifts that will redefine how value, autonomy, and influence function in the years to come. The outlines of that transformation are already visible to anyone willing to observe the world without accepting the default explanations offered to them. And once you notice those outlines, you can't help but follow where they lead, step by step, into the next layer of the pattern. If you stayed with me until now, let me know in the comments by writing the phrase, "I'm here until the end." It's a simple way for me to see who's truly following the depth of this journey. And if this content has given you clarity or opened a new way of seeing the world, consider subscribing so you can stay close to the discussions that will unfold from here. A like also helps this message reach others who might need it. And before you go, there's a video here beside this one that continues this line of thought from another angle. Click it and keep walking with me through what lies beneath the surface.